How did the absolute greatest economic boom in human history collapse into, well, a devastating financial black hole? Now, for decades, the story we've been told is pretty simple, right? Japan just got greedy. A wild real estate mania naturally ran its course, the bubble popped, and the free market just corrected itself. But what if that's not the whole truth? The sources we're diving into today suggest a much wilder narrative. They argue the free market didn't just correct itself, it was pushed.
So let's dive into what's basically an economic true crime story. Because the research we're unpacking makes the case that this wasn't some random market accident at all. No, it was the result of a closed-door meeting, a targeted, surgical move to pull a massive geopolitical lever. But hey, before we get to the weapon itself, we really need to understand the target. Just how astronomically wealthy was Japan in the late 1980s? Let me paint a picture for you.
To really grasp the absolute peak of this mania, economists made this famous calculation, and it is mind-blowing. Imagine taking just the 1.15 square kilometers of dirt sitting right underneath the Emperor's Palace in Tokyo. That tiny, little patch of land was valued higher than all the real estate in the entire state of California combined. Literally. Every single beach house in Malibu, every mega mansion in Beverly Hills, every towering skyscraper in San Francisco, one Japanese palace was worth more than the whole shebang. Crazy, right?
Japanese investors were practically buying up the world. Sony bought Columbia Pictures. Mitsubishi scooped up an 80% stake in Rockefeller Center. And there was this Japanese businessman, Roei Saito, who dropped a staggering $82.5 million on a Vincent van Gogh painting at auction. Why? Honestly, just because he could. He even famously claimed he wanted the masterpiece cremated with him when he died. The wealth flying around totally defied any kind of modern economic logic.
Okay, so to understand the motive for the crash, we gotta rewind just a bit to the late 1970s. Over in the US, the Federal Reserve was battling historic inflation and cranked their base interest rates up to an eye-watering 19%. 19. This extreme rate basically acted like a giant, irresistible magnet for global wealth. Foreign investors just flooded money into the US, and all that surging demand supercharged the value of the US dollar. Now, a strong dollar sounds great on paper, doesn't it? But in international trade, well, it's a functional death sentence for your domestic factories.
Think about it. Because the dollar was just so incredibly strong, an American-made tractor exported over to Japan suddenly became laughably expensive. Your export business? Dead on arrival. But on the flip side, imported Japanese goods became incredibly cheap for American consumers. By 1987, Japan accounted for 36% of the entire U.S. trade deficit. That's $57 billion. Motor vehicles and auto parts alone made up almost a third of all imports from Japan. America was bleeding out on the factory floor, permanently hemorrhaging millions of manufacturing jobs. Down on that factory floor, this whole macroeconomic shift morphed into this visceral, really performative outrage. Politicians and labor leaders actively weaponized the frustration boiling over in the American Rust Belt. I mean, unemployed union workers were literally paying $1 just for the opportunity to swing sledgehammers at Japanese-made cars at charity events. Members of Congress actually smashed a Toshiba radio on the Capitol lawn for the cameras. Washington knew this trajectory was completely unsustainable. Honestly, the U.S. was teetering right on the edge of a 1930s-style global trade war. But instead of a messy, drawn-out trade war, the U.S. Treasury Department opted for a surgical strike, September 1985, at the Plaza Hotel in New York. The U.S. delivered a pretty clear ultimatum to Japan and other major economies: artificially appreciate your currencies to weaken the dollar, or Congress is going to lock your exports right out of the American market. So they signed the Plaza Accord. The central banks coordinated an attack, just dumping tens of billions of U.S. dollars onto the open exchange markets. The really crucial takeaway here is that this elegant geopolitical weapon instantly crippled Japan's export-driven economic miracle. It was immediate. Within 2 years, the Japanese yen had practically doubled in value against the dollar. So suddenly, Japanese goods were twice as expensive for international buyers, which led directly into the strong yen recession of 1986. Major steel and shipbuilding plants completely shut down. Nearly 900,000 surplus workers were left stranded across the manufacturing sector. Looking through this historical lens, Japan had walked directly into a massive geopolitical trap.
Terrified of total economic collapse, the Japanese government needed a desperate new strategy, fast. They realized they had to stimulate domestic demand. They needed to get their own citizens and corporations to borrow and spend entirely inside Japan. To pull this off, the Bank of Japan yanked its biggest lever. They slashed their official discount rate in this rapid series of cuts, bringing it all the way down to a historic low of 2.5%, and they kept it there for over 2 years. They effectively put up a giant neon sign over the country flashing, "Money is practically free. Come and get it."
Now, because export avenues were totally choked off by the strong yen, companies just couldn't make a profit selling cars or electronics abroad anymore. This birthed a brand new era, Zytec, or financial engineering. Industrial companies essentially mutated into hedge funds. They realized, hey, it's way more profitable to borrow this practically free money and dump it straight into financial speculation, like stocks and real estate, rather than, actually building better factories or funding new research.
And wow, did this create a truly terrifying financial engine. Traditional banks were losing corporate clients to new bond markets, so they pivoted hard to real estate. Since land in Japan is super scarce, banks accepted it as fail-proof collateral. Here's how it worked. Borrowers took out massive loans to buy land. That buying frenzy drove land prices up. Because the land was suddenly worth more, the underlying collateral rose, which legally allowed banks to lend even more money to those exact same borrowers, who then went out and bought even more land and stocks. It was an uncontrollable, self-feeding feedback loop of pure credit creation. Driven by this endless fire hose of credit and a really tight system of cross-shareholding between corporations and banks, the stock market just exploded. The Nikkei index, which was hovering around 13,000 in early 1986, rocketed to a mind-bending intraday high of 38,957 by December 1989. Think about that. The stock market virtually tripled in less than 4 years. It was utterly, completely divorced from any actual corporate performance. And real estate? It was just as unhinged. Even though Japan has only 4% of the landmass of the United States and 100 million fewer people, by 1990, Japan's total real estate market was valued at 4 times that of the entire United States. That is staggering. Real estate made up an absurd 65% of Japan's total national wealth. Market participants just actively convinced themselves that these super low interest rates and double-digit asset growth would literally continue forever. But as we all know, there is a fundamental law of economics. No system can sustain infinite, debt-fueled exponential growth indefinitely. In late 1989, the Bank of Japan finally woke up from this euphoria. Recognizing that the asset bubble was dangerously out of control, a newly appointed central bank governor, Yasushi Mieno, abruptly reversed course. He forcefully cranked the official discount rate up, hiking it all the way to 6% by August 1990. The needle had finally, inevitably, touched the balloon.
The impact was absolutely catastrophic, and it happened practically overnight. Lending costs skyrocketed, completely choking off the flow of cheap credit that was keeping those massive Zytec operations afloat. The Nikkei entered a terrifying freefall, losing 40% in just 1 year and eventually wiping out 60% of its peak value. Commercial land prices eventually dropped by half. Corporate borrowers were suddenly drowning underwater, owing billions more than their hyperinflated real estate assets were actually worth in reality.
Normally, a healthy capitalist system handles this through creative destruction, right? Bankruptcies, liquidating assets, taking the massive loss, and eventually moving on. But terrified Japanese banks just couldn't do that. If they admitted the money was gone, they'd fail international capital reserve standards and face a catastrophic global collapse. So what did they do? They turned to a practice known as evergreening. They started issuing sham loan restructurings, handing out new credit to functionally dead corporations just so those companies could make the minimum interest payments on their old debt. They were literally hiding the bodies.
This total refusal to accept reality birthed a completely parasitic economy. By the early 2000s, nearly a third of all publicly traded firms in key sectors were zombie companies. It's a terrifying economic concept, and one that's still heavily debated today. These were businesses that were technically dead, generating cash flows that were nowhere near enough to cover their debt, but they were kept on state life support purely to avoid recognizing the financial catastrophe. They hoarded market share and completely choked off banks from lending to healthy, innovative startups.
Ultimately, Japan refused the short-term pain of a crash and instead chose the long-term agony of a slow decay, triggering what we now call the lost decades. Economic growth basically flatlined to just over 1% annually. Their share of global GDP absolutely plummeted. But the human toll, that was undeniably the most devastating part. The foundational promise of lifetime employment in Japan was destroyed forever, replaced by cheap temporary workers. And tragically, this profound psychological trauma led to a relentless spike in suicides, particularly among men in their 40s and 50s, the salarymen, who bore the deep cultural shame of the collapse.
According to the sources we've unpacked today, when the core industrial survival of the U.S. was threatened, Washington used its massive diplomatic gravity to force a structural change in the global financial system. They cornered Japan into inflating a bubble and then watched as it consumed them.
So whether you view this as just a natural market cycle or a calculated economic strike, these sources leave us with a deeply chilling final thought from Henry Kissinger. It may be dangerous to be America's enemy, but to be America's friend is fatal. It really makes you wonder, what happens when your greatest ally simply decides you've become a little too successful? Thanks so much for joining me on this explainer.